Hello and welcome. This presentation has been put together by the experts over at My Tax Accountant, and today we're diving into a really powerful strategy for UK business owners, how you can use your pension to buy your very own commercial property. Let's jump right in.
So, let me start with a big question. What if the rent your business pays out every single month, instead of just going to a landlord, could be funneled directly into your own pension? Imagine funding a retirement with it, completely tax-free. It honestly sounds a bit too good to be true, doesn't it? But stick with me because it's a very real and clever strategy.
So, how on earth is this possible? Well, the key is something called a SIPP, which stands for a self-invested personal pension. Now, the big difference between a SIPP and a standard pension all comes down to one word: control. A SIPP gives you the freedom to invest in a much wider range of things, and that includes the star of our show today, commercial property.
Right, here's our roadmap for today. We're going to look at what kind of property you can actually buy, uncover the incredible tax advantages, figure out how you'd fund the purchase, and crucially, how to avoid HMRC's biggest red flags. And then we'll talk about your next steps.
Okay, let's get straight into the practical stuff. Can your pension just go out and buy any old building? No, absolutely not. HMRC has some very clear, very strict rules about what's allowed inside a SIPP, and getting this right from the get-go is the most important first step.
So, the number one rule is this: a SIPP can only invest in commercial property. Simple as that. Now, as you can see, the allowed list is pretty broad. We're talking offices, shops, warehouses, even things like gyms and agricultural land. But that forbidden list, that's non-negotiable. Any kind of residential property, flats, houses, holiday lets, is completely off limits. Trying to put one of those in a SIPP is a huge mistake and comes with massive tax penalties.
Okay, so that brings up a really common real-world scenario. You see them all the time, right? A shop on the ground floor with a flat above it. So can your SIPP buy that whole building? And this is where things get a little bit tricky, but also quite interesting.
Here's the catch from HMRC. If there's any kind of internal connection between the shop and the flat, like a shared hallway or an internal door, then the entire building is treated as residential property. And as we just established, that makes it a complete no-go for a SIPP. Buying it directly would be a disaster, triggering those severe tax charges we want to avoid.
But don't worry, there's a very clever legal solution to this. Let's walk through it. First, you personally make an offer and buy the entire building, the freehold. Then, at the same time, your solicitor works some magic and creates a brand new, separate legal title, a long leasehold, for only the commercial part. This legally splits the property in two. After an independent surveyor gives a strict valuation of that new commercial part, your SIPP then buys just that leasehold from you. And voila, your SIPP holds a compliant commercial asset and you personally own the residential bit.
So, we've navigated the tricky part of what you can actually buy. But you might be thinking, wow, that sounds like a lot of hassle. So why would you even bother? Well, let's dive into the tax advantages, because this is where the strategy really starts to shine. This creates a fantastic win-win situation. Here's a pro tip for you. Picture this: your SIPP now owns your office. Your business pays rent, let's say £2,000 a month, but it pays it to your own pension. That rent payment is a tax-deductible expense for your business, which lowers your corporation tax. But the money lands in your SIPP completely tax-free. You are literally paying yourself and building your pension with money that would have otherwise gone to the taxman.
And that brings us to the first massive benefit. If you owned that property in your own name, you'd be paying income tax on all the rent you receive. But inside a SIPP, every single penny of rent flows straight into your pension pot with zero income tax to pay. It all goes towards your retirement.
The second huge advantage pops up when it's time to sell. Let's say your SIPP buys the property for £300,000 and 10 years down the line, sells it for £450,000. That's a $150,000 profit. Normally, you'd face a hefty capital gains tax bill on that. But because the property is inside the tax-free SIPP wrapper, the gain is 100% tax-free.
And the third major benefit, at least under the current rules, is inheritance tax. Right now, your SIPP, including the property, sits outside of your estate, making it a super efficient way to pass wealth on. Now, quick heads up, the government has proposed some changes that might affect this from April 2027, so it's definitely something to keep an eye on with your advisor.
Okay, the benefits are clear, they're powerful, they're very real. But the big question is, how do you actually find the cash to do this? So let's look at the practical side of things, how you can fund a property purchase inside your SIPP.
So where does the money come from? Well, it's usually a combination of three things.
You can gather up any old pension pots you have from previous jobs, you can make new contributions, and, this is a big one, your SIPP can actually borrow money to help get the deal over the line.
And speaking of new contributions, here's a quick did you know for you. For the 2025/26 tax year, the annual pension allowance is a very generous £60,000. That's the total you and your company can put in, and it can give your SIPP's buying power a serious boost.
The borrowing part is also incredibly powerful. A SIPP is allowed to borrow up to 50% of its net value. Let's take Sarah, a freelancer, as an example. She's pulled her old pensions together, and her SIPP is now worth £200,000. This means she can borrow up to half of that, another $100,000, giving her a total war chest of £300,000 to go out and buy her own office.
Okay, this next part is absolutely crucial, so please stay with me. We're about to talk about HMRC's biggest red flags. Getting any of this wrong can completely undo all the hard work and lead to some pretty nasty penalties. That's not all. This is where most people go wrong.
You have to get your head around the term connected transaction. Basically, this is any deal your SIPP does with a connected party. And that means you, your family, or your business. Because you're on both sides of the deal, HMRC looks at these transactions with a microscope to make sure everything is fair and above board.
And this brings us to the golden rule. Everything has to be done at market value. The price your SIPP pays for the property must be the exact value set by an independent RICS surveyor. Not a penny more, not a penny less. You can't give your SIPP a bargain, and you can't sell it an overpriced asset. The same goes for the rent your business pays. It has to be the going market rate.
And believe me, breaking this rule is a really big deal. HMRC sees any funny business with the numbers as an attempt to improperly pull money out of the pension, and the penalties are designed to sting.
If your SIPP pays too much for your property or your business pays too little rent, that difference is classed as an unauthorized payment. This instantly triggers a tax charge of a whopping 40% on that amount, and there can be even more penalties on top. It's an incredibly expensive mistake to make.
Right, we have covered a huge amount of ground here, from what you can buy to the tax perks and the critical rules you just can't ignore. So let's pull it all together and talk about how you can turn all this knowledge into a safe and effective plan of action.
So, let's quickly recap. You can use your SIPP to buy your own UK commercial property, turning rent from an expense into a tax-free investment in your future. You can fund it through contributions and borrowing. But, and this is the big one, any transaction with yourself or your business must be at an independently verified market value. As you've seen, the rules are complex and the penalties for getting it wrong are severe. That's why professional advice isn't just a good idea, it's absolutely essential.
Now, it's really important for me to say this. All the information we've discussed today is for general guidance. It is not financial advice, and it shouldn't be the only thing you rely on to make big financial decisions. Everyone's circumstances are different.
So, before you take any steps, you must consult with the experts. The rewards of this strategy can be absolutely immense, but the complexity means you really shouldn't try to go it alone. Getting proper advice from the very beginning is the key to getting it right.
For expert guidance that's tailored to your specific situation, you should get in touch with the team at My Tax Accountant. All their details are on the screen now. You can give them a call on 028 570 8531 or drop an email to info@mytaxaccountant.co.uk. I also highly recommend you read the full detailed article on their blog and, of course, subscribe to their YouTube channel for more fantastic insights like this. Thanks so much for watching.